First, we're going to start talking about the 2020 computation. And here's just some general information about the rules for 2020. So in 2020, for those who qualify, the credit is 50% of qualified wages per employee, up to $10,000 in wages. So essentially the credit in 2020 is $5,000 per employee. When you're looking at what is qualified wages, we won't go into too much detail here. The IRS refers to section 3121A and the definition of wages in that section. Usually it includes W-2 wages, but it may include other wages as well. It also includes, for this credit, amounts paid for qualified health plan expenses. And when you're looking at wages and who they're paid to for qualified companies, it's different in 2020 whether you have 100 or fewer full-time employees compared to if you have more than that. So if you're a qualified company, which we'll get into, that had 100 or fewer full-time employees in 2019, you'd be looking at the wages paid to all employees during that qualified period. If you're over 100 in 2019, then for each qualifying period in 2020, you'd be only looking at those wages paid to employees that were not providing services. And we'll talk about that in more detail. Don't get discouraged if you are a company that has more than 100 full-time employees in 2019, as this threshold increased for the 2021 computation. So instead of 100, it was increased to 500 full-time employees. And we're going to get into that a little bit later as well. Just keep in mind that the credit generally offsets an employer's share of Social Security tax, but any excess is treated as an overpayment and is refunded, so it's a refundable credit. Next, we're going to talk about who are eligible employers. So some of you might have heard about these two tests, which you would generally look at to see whether you are eligible for the credit. Only one of these tests have to be met. The first test is looking at whether the operation of your trade or business carried on during 2020, and we'll get into 2021 as well. But for this purpose, we're looking at the 2020 credit computation. If you had a trade or business that was fully or partially suspended due to a governmental order which limited commerce, travel, group meetings due to COVID-19, then you would likely meet that first test. If you don't meet that test, or if you do meet that test, you could still look at the second test, which is the gross receipts test. And we're going to talk about how that's actually looked at later on. But essentially, for each quarter in 2020, you'd be looking at the gross receipts from the same quarter in 2019 to determine whether there's a significant decline in gross receipts. You do that on a quarter-by-quarter basis. And for 2020, you'd be looking at whether you had at least a 50% reduction in gross receipts from that same quarter in 2019. So if you don't meet the gross receipts test, you could still meet the first test, which is looking at whether more than a nominal amount of your operations was fully or partially suspended. And we'll talk about how you could still qualify, perhaps if your suppliers who by themselves may have been suspended due to a governmental order was unable to deliver essential supplies to your business, which impacted your operations. That's just one example of from the IRS's FAQs that discuss how companies may still qualify under this first test. So don't get discouraged if you don't meet the gross receipts test, because it may still be a good idea to look at whether the first test applies. Within the definition of eligible employers, there's no limit for the number of employees that the employer has, although, like we had just discussed, the credit is more lucrative in 2020 if you had 100 or fewer full-time employees, and then obviously that number increased to 500 for the 2021 computation. There is a requirement that you do operate a trade or business. For 2020, government entities were not eligible, but some are in 2021. and tax-exempt organizations under 501c are generally eligible. So let's talk about what is an order from an appropriate governmental authority. This is going back to the first test that you look at. So these are orders, proclamations, or decrees from the federal government, state or local government, if they had limited commerce, travel, or group meetings due to COVID-19. Generally, a statement from a governmental official does not rise to that level of substantiation. The FAQs also state that CDC recommendations are not considered a governmental order in relation to this credit. So it's important to understand and document the relevant governmental orders that may have applied to your business. And this slide talks about how you can interpret what is a full or partial suspension. So it says that an employer that operates an essential business is not considered to have a full or partial suspension of operations if the governmental order allowed all of your operations to remain open. However, if you operate an essential business, you may still be considered to have partial suspension of operations if more than a nominal portion of your business operations were suspended by a governmental order. So you're not automatically disqualified if you run an essential business if more than a nominal portion of your business was partially or fully suspended. So what is meant by nominal? Nominal either means that the gross receipts from that portion of the business operations is at least 10% of the total gross receipts, or generates at least 10% of the total gross receipts for the company, or the hours of service performed by employees in that portion of the business is not less than 10% of total hours performed by employees within the entire organization. So this is straight from the IRS's FAQs regarding the employee retention credit. It details that example that I provided earlier where perhaps if your suppliers were suspended and you were unable to get essential supplies that impacted your ability to do business, even though you may not have directly been fully or partially suspended by a governmental order, you may still qualify under this partial suspension. The question here is, if a governmental order causes the suppliers to a business to suspend their operations, is the business considered to have a suspension of operations due to a governmental order? So in the FAQs, the answer is that an employer may be considered to have a full or partial suspension of operations due to a governmental order if, under the facts and circumstances, the business's suppliers are unable to make deliveries of critical goods or materials due to the governmental order. So it's a facts and circumstances test. Again, it's important to really look at whether, if you don't meet the gross receipts test, whether this first test applies to your business. Second test, obviously, is doing the gross receipts test. So again, for each quarter in 2020, you'd be looking at whether there was at least a 50% reduction in gross receipts compared to the same quarter in 2019. If there was, then the qualification period ends with the first quarter that follows the first quarter, which gross receipts are at least 80% of what they were. And we'll show an example of that right here. So again, this is from the FAQs. An employer's gross receipts were 100,000, 190,000, and 230,000 in Q1, Q2, and Q3 of 2020. Its gross receipts for the same quarters in 2019 were 210,000, 230,000, and 250,000. So in this example, employers A's 2020 Q1, Q2, and Q3 gross receipts were approximately 48%, 83%, and 92% of its 2019 Q1 through Q3 gross receipts. So you can see that in that first quarter, it meets the at least a 50% reduction test. So the answer in this example is that the employer experienced a significant decline in gross receipts commencing on the first day of the first calendar quarter of 2020. And it ended on the qualification period ends on the first day of the third quarter of 2020, because the rule says that the quarter following the first quarter in which gross receipts were more than 80% of those in the same quarter of 2019 is how the qualification period is determined. So in Q2, gross receipts were 83% of what they were in 2019. So in this example, the ERC qualification period would include Q1 and Q2 of 2020, because again, you're looking at that first quarter following the quarter in which gross receipts are at least 80% of what they were in 2019. This slide just shows you how gross receipts are defined for the gross receipts test for both taxable entities and tax-exempt entities. Generally, for taxable entities, you'd be including total sales, net of returns and allowances, interest, dividends, rents, royalties, annuities. Tax-exempt entities would look at gross receipts from all business operations, interest, dividends, rents, royalties, and other components as well. So for this full-time employee test, again, I mentioned that just for the 2020 tax year, if you qualify during a quarter, you'd be looking at wages paid to everyone if you have 100 or fewer full-time employees. So this slide defines what is meant by full-time employees. For purposes of this credit, a full-time employee is one that averaged at least 30 hours of service per week, or 130 hours of service in the month. So again, if you have 100 or fewer, you take the credit on all wages up to $10,000 per employee in 2020. If you have more than 100, then you'd only be looking at amounts paid to employees that were not providing services. Again, this threshold increased from 100 to 500 in 2021. So what does it mean to pay employees that are not providing services? This is another example relating to a fitness club that had employed an average of more than 100 full-time employees in 2019. They closed all of their locations due to an order by City B's mayor. The fitness club continues to pay its exempt managerial employees their regular salaries while the clubs are closed and there isn't sufficient admin work to occupy these employees. They continue to perform some accounting and some admin functions. So in this example, the employer determined that based on their time records, that these employees are providing services for 10% of their typical work hours. So in this example, the remaining 90% of wages paid to these employees would be considered qualifying wages. So this slide shows you a summary of what was enhanced in the 2021 ERC extensions. So the ERC was extended to include all periods in 2021. So employers that received a PPP loan could also qualify for the ERC. That's retroactive to 2020. Initially, when the credit was first enacted, those who received a PPP loan were automatically disqualified. But now, even if you received a PPP loan, you may still qualify for the ERC. The only caveat is that you can't use the same wages that you used for your PPP loan forgiveness as you do for the ERC computation. So there's no double dipping. So if you haven't applied for PPP loan forgiveness yet, and you think you qualify for the ERC, it's important to use the least amount of possible wages for your PPP loan forgiveness. If there's other qualifying expenses that you can use for your PPP loan forgiveness, then you probably wouldn't want to use all that PPP loan forgiveness on wages, since you can't double dip. So you want to have some there potentially for your ERC credit as well. The big difference in 2021 is that the credit percentage increased from 50% to 70%. So instead of looking at 50% of qualifying wages, which in 2020, 50% of 10,000 was how you got the 5,000 cap per employee annually. In 2021, you'd be looking at 70% of 10,000 in wages, so it's 7,000 per employee. But the other big difference here is that cap is on a per quarter basis and not on an annual basis. So essentially, qualifying employee in 2021 could generate $28,000 in ERC credit because, again, it's 70% of 10,000, so 7,000 of credit per qualifying period per quarter in 2021. And the full-time employee threshold increased from 100 to 500. So if you had less than